2690 looked good for a while with you, but if it got below that, I think you had a 2510 on the S&P. That if it got to that and broke under that, we were in trouble. And we broke under that.
That's right. So
yeah, we broke under that.
We did.
Yeah, and then the next level was something where you said things would really be hitting the fan. That was 22. What? We didn't get there. What was it?
It's around 2240. And so what that means, of course, is really the bottom has dropped out in terms of where there's support for the S&P 500. What's important to note is that we did confirm that breakdown below that level, which was 2640 originally, and then subsequently took out 2510. So that's really a reflection of the negative momentum behind the tape. And what I was concerned by was the lack of a reaction to that very, very strong oversold extreme reading that we had. We still do, of course, have an oversold reading. We're reacting to it now, finally, and really have room to the upside in the very near term in this relief rally. So I do think we're getting another selling opportunity, or will have a better selling opportunity in the coming weeks as we rebound here. However, the damage is already done to the charts.
Selling. So you're looking at strength to sell then?
That's right. So now looking at strength because of that breakdown, that confirmed breakdown below support, and also the lack of the reaction to oversold conditions, we now want to use rallies as selling opportunities. I'd say best case scenario is that we're in some kind of 2015-16 type of environment where even possibly the worst is over despite how far below that next support level is. But it's a much more challenging environment in terms of stock selection and really being in the right sectors where you have to end up being a bit more short term in your positioning to take advantage of the volatility and the swings. Some people are very good at that, of course, and it can be very difficult.
So how long are we talking about it being in this period? Is that what's your normal time?
I think it's cyclical. Yeah, cyclical, not years, but months, something that might make for a difficult Q1, early Q2. We really kind of take it as it comes and evaluate the readings that we get. We do have an intermediate term oversold reading as it stands, and hence the need for more of a relief rally, especially noting that the 50-day moving average for the S&P 500 is more than 7% above current levels. So it could be more of a relief rally with that in mind, of course.
Okay, so then 7% above the relief rally could be expected to get there. But Peter out there, what number is that? Just do the math for me from where we are now.
It's around 2667, so just over 7% above. And yet, of course, the next support is about 10% below. So the risk reward is not that favorable, except in the very near term with that in mind. So what we'll be looking for in Q1, Q2, looking for a longer term oversold reading and really just improve momentum, broadly speaking. We'll look at the intermediate term momentum gauges and wait for those to flash buy signals as opposed to take those initial moves and really believe in them.
Do you have correlated assets that you follow and have things? I mean, I guess you always do the 10-year for us. I mean, do you do oil? Do you do commodities like copper? Really? I mean, all these things, unfortunately,
they're all on my radar, yeah.
But they all are sort of, I mean, they look like they're trying to indicate some type of problem, right? I mean, whether it's global slowdown in growth or, I don't know, maybe some
well, it's really been sort of
stress,
a macro,
credit stress. Yeah, I mean, it's scary.
Macro move.
Yeah. Do you have any idea fundamentally what we're talking about here? Or you don't really?
Not fundamentally, but technically it does seem to be fairly broad-based. I think, with crude oil, there's no doubt that it's seen a bearish reversal, at least on a cyclical basis. So that's an important thing to note. Copper really doesn't look great from a technical standpoint, as you might imagine. And 10-year Treasury yields are testing a very important gradual long-term uptrend line. So all these things are at pivotal levels on their charts. High-yield bonds have broken down as well. So we're keeping an eye on those things. And certainly, I'd say taken together, they don't make a very positive comment on the fundamentals.